What if I told you that you could legally pay zero taxes on your Social Security benefits? Not by hiding money, not through shady loopholes, but through 6 simple IRS-approved strategies that could save you thousands of dollars every single year. Most retirees have no idea these strategies exist. They're giving the government 15%, 25%, even 50% of their Social Security checks when they do not have to. In 2026, with the average Social Security benefit sitting at $2,071 per month, those taxes add up fast. We're talking about thousands of dollars that could be staying in your pocket. Today, I'm breaking down 6 powerful strategies to eliminate taxes on your Social Security benefits completely. These are legal, straightforward moves that work anywhere in America. Let's dive in. Before we get started, here's what's new for 2026. Social Security recipients just got a 2.8% cost of living adjustment. That's about $56 more per month for the average retiree. Not bad, but it's not keeping up with healthcare costs, which are still climbing. And here's the reality check. The Social Security Trust Fund is projected to face cuts around 2035, unless Congress fixes the system. That's less than a decade away. So every dollar you can save on taxes today matters more than ever. Now, here's how Social Security taxation works and why you need to care. The IRS looks at something called your combined income. That's your adjusted gross income, plus any non-taxable interest, plus half of your Social Security benefits. For single filers, combined income between $25,000 and $34,000, up to 50% of your benefits are taxable. Over $34,000, up to 85% of your benefits are taxable. For married filing jointly, combined income between $32,000 and $44,000, up to 50% taxable. Over $44,000, up to 85% taxable. These thresholds have not changed since the 1990s. Thanks to inflation, more retirees than ever are getting hit with taxes on their benefits. But here's the good news. With the right strategies, you can legally keep your combined income below these thresholds and pay zero in taxes. Let's break down exactly how to do it. Strategy number 1, shift to Roth accounts for tax-free income. This is the heavyweight champion of tax reduction strategies. Here's the problem with traditional retirement accounts. Every dollar you withdraw from a traditional IRA or 401k counts as taxable income. It inflates your adjusted gross income, which pushes up your combined income, which triggers taxes on your Social Security. It's a vicious cycle. Enter Roth accounts. With Roth IRAs and Roth 401ks, you pay taxes on the money before you put it in. But then, and this is huge, all the growth is tax-free and all qualified withdrawals are tax-free. And here's the kicker. Roth withdrawals do not count toward your combined income. They're invisible to the IRS when it comes to Social Security taxation. For 2026, contribution limits are up to $7,500 if you're under 50 or $8,600 if you're 50 or older. Income phase-outs start at $153,000 for singles. Let me show you a real example. Imagine you're a married couple with $30,000 in traditional IRA withdrawals plus $24,950 in annual Social Security benefits. Your combined income is $30,000 plus $12,226, half your Social Security, $42,126. That puts you over the $32,000 threshold, so up to 50% of your Social Security is taxable. Now, what if you switched $20,000 of those withdrawals to a Roth account? Your AGI drops to $10,000, add half your Social Security, $12,426, and your combined income is now $22,426. That's under the $32,000 threshold. Zero taxes on your Social Security. Here's the strategy. Do Roth conversions during low-income years, maybe right after you retire, but before you claim Social Security. You'll pay taxes at a lower rate up front, but then you're set for life. Space out the conversions over multiple years to avoid jumping into higher tax brackets all at once. This is massive for middle-class seniors. You cut your taxes now and spend more freely later. Strategy number 2, delay claiming Social Security. This one's simple but powerful. Do not rush to claim your benefits. Every year you wait past your full retirement age, which is 67 for most people born in 1960 or later, your benefit increases by 8%. That's guaranteed. No market risk, just pure growth. Plus, if you have not claimed Social Security yet, you're not paying taxes on it. Simple as that. Here's the math. If you claim at 62, you lock in about 30% less than your full benefit. With the 2026 average of $2,071 per month, claiming at 62 gives you about $1,450 per month. Wait until 70, and you get $20,768 per month. That's a $118 difference every month. Over a lifetime, if you live to 85, delaying could add over $300,000 in total benefits. But here's the tax angle. While you're delaying, you can live off other sources, savings, Roth accounts, part-time work. Keep your income low during those years. And when you finally do claim Social Security, your higher benefit is more likely to stay below the taxation thresholds. Now, I'm not saying everyone should delay. If you have health issues or family history suggests a shorter lifespan, claiming earlier makes sense. You need the money now. But if you're healthy and can cover your expenses with other income, delaying is one of the smartest financial moves you can make. Check out our video on Social Security break-even calculators, link in the description, and use the SSA's online estimator to run your own numbers. In today's gig economy, where remote work and flexible jobs are everywhere, you can bridge that gap between retirement and age 70 without touching Social Security. Strategy number 3. Max out health savings accounts. HSAs are the triple threat of tax savings. Here's how they work. 1. Contributions are pre-tax, which lowers your adjusted gross income immediately. 2. The money grows tax-free inside the account. Invest it and watch it compound. 3. Withdrawals for qualified medical expenses are tax-free. It's the only account in the tax code with 3 tax benefits. For 2026, contribution limits are $4,400 for individual coverage and $8,150 for family coverage. If you're 55 or older, you get an extra $1,000 catch-up contribution. And here's why this matters more than ever. Healthcare inflation is outpacing general inflation. Medical costs are up 20% since 2021. You're going to have medical expenses in retirement, guaranteed. So why not use them to slash your taxes? Here's an example. Let's say you withdraw $5,000 from your HSA to pay for doctor visits, prescriptions, and medical equipment. That's $5,000 in expenses you're covering tax-free. But more importantly, it's $5,000 less that you need to withdraw from your traditional IRA or 401k. That keeps your adjusted gross income lower, which keeps your combined income lower, which could keep you below the Social Security taxation threshold. Pro tip, contribute to your HSA while you're still working. Invest the funds aggressively for growth, and then use it in retirement for medical expenses. Let it grow for decades if you can. Unlike flexible spending accounts that expire each year, HSAs roll over forever. They're perfect for covering Medicare premiums, out-of-pocket costs, and prescription drugs. Pair an HSA with a high-deductible health plan. Invest in low-fee index funds, and many people see 7% annual returns or more. This is a no-brainer strategy for anyone eligible. Strategy number 4, make qualified charitable distributions. If you're 70 and a half or older, this strategy is pure gold, especially if you're charitably inclined. Here's how it works. Instead of taking money out of your traditional IRA and writing a check to charity, you donate directly from your IRA to the charity. It's called a qualified charitable distribution, or QCD. For 2026, you can donate up to $111,000 this way. And here's the magic. QCDs count toward your required minimum distributions, but they do not add to your adjusted gross income or your combined income. Let me repeat that. It satisfies your RMD, but it's invisible to the IRS for tax purposes. Here's an example. Let's say you're required to take a $10,000 minimum distribution from your IRA. Normally, that $10,000 gets added to your taxable income, pushes up your combined income, and potentially triggers taxes on your Social Security. But if you make a $10,000 QCD instead, that money goes straight to the charity. It satisfies your RMD requirement, but it never shows up on your tax return. Your combined income stays lower, and you might avoid Social Security taxation entirely. Plus, you do not need to itemize deductions to get this benefit. It works, even if you take the standard deduction. Bonus, starting in 2026, there's a one-time option to donate up to $55,000 to a split interest entity like a charitable remainder annuity. That's for more advanced planning, but it's available if you want to make a larger gift. If giving to charity is part of your retirement plan anyway, this is a slam dunk strategy. You're doing good while slashing your tax bill. Strategy number 5, tax loss. Harvesting with underperforming investments. This one's perfect for retirees with investment portfolios, and with market volatility in 2026, there are plenty of opportunities. Here's the concept. If you have stocks or funds that have lost value, you can sell them, lock in the loss, and use that loss to offset your income. You can deduct up to $3,000 in losses against your ordinary income each year. And if you have more losses than that, you can carry them forward to future years. Here's an example. Let's say you bought a stock for $10,000 and it's now worth $8,000. You sell it. You get $8,000 in cash, no capital gains tax because there's no gain. You have a $2,000 loss that you can deduct from your adjusted gross income. For a married couple, if that $2,000 deduction keeps your combined income under $32,000, you just eliminated taxes on your Social Security benefits. Important. Watch out for the wash sale rule. You cannot buy back the same stock or a substantially identical investment within 30 days, or the IRS will disallow the loss. But you can sell one tech stock and immediately buy a different tech stock. You stay invested in the market while harvesting the loss. Robo-advisors like Betterment and Wealthfront can automate this process for you. They scan your portfolio daily and harvest losses whenever they appear. In today's volatile market, with AI booms, crypto dips, and economic uncertainty, there are always opportunities to harvest losses and reduce your tax bill. Strategy number 6, leverage rental real estate for depreciation deductions. This one's for retirees who own rental properties or are thinking about buying one. Here's the deal. Rental income is taxable, but rental properties come with a massive tax benefit called depreciation. Depreciation is a non-cash deduction. You do not spend any money, but you get to write off a portion of the property's value each year. For residential rental properties, you depreciate the building over 27.5 years. Here's an example. You buy a $200,000 rental property. You can depreciate about $7,000 per year. Let's say the property generates $15,000 in annual rent. After you deduct mortgage interest, property taxes, maintenance, and that $7,000 depreciation, you might show a loss on paper, even though you pocketed cash. The paper loss reduces your adjusted gross income, which lowers your combined income, which could eliminate taxes on your Social Security. Post-pandemic, rental demand has surged with remote work fueling relocation. Short-term rentals like Airbnb can generate even more income in the right markets. If you do not want the hassle of managing properties, consider real estate investment trusts, REITs. They're more hands-off, though the tax benefits are not as strong. The downside? Property management takes work. Tenants, repairs, vacancies. It's not passive income for most people. But if you're willing to put in the effort or hire a property manager, the tax shield is massive for investor-minded seniors. Closing. Implementing even 2 of these strategies could save you thousands of dollars every year. And here's the bottom line. With Social Security, its future uncertain and the cost of living rising, every dollar you save matters. Do not leave money on the table. Use these legal IRS-approved strategies to keep more of your hard-earned benefits. If you found this helpful, smash that like button and subscribe to American Seniors Finance. Hit the bell so you never miss a money-saving strategy. Drop a comment below. Which strategy are you going to try first? Thanks for watching.